Morning, I'm Jeremy McLean of the Hedgeye Retail team. Thank you for joining us today. Excited to talk about retail here on Hedgeye's The Outlook. And, we have a new Retail Sector Pro product out. It's got some good offerings. You can see, see what we're doing in terms of idea changes, what things we're looking at, bullish and bearish side. And it's a new product that's only going to get better. We excited about that. And with that, I'm going to turn over to Brian to hit on some of the key things we're talking about in retail.
Great, thanks, Jam. I appreciate it. I wish you could be here with me in the studio, but we're doing the Group A, Group B thing in the COVID world where we both can't be in the same office on the same day, so we got to make do with what we can. But I got a bunch of slides up here. I just want to walk you through our process overall, how we think about stocks, a couple of the main themes which are coming up right now that we're dealing with. And most of all, I want to hit on our top picks because ultimately this is about stock calls. It's about making money. I think there's a lot of good trade ideas, a lot of good trend ideas, and a lot of good tail ideas. Trade, trend, tail being our three durations here. Trade being 3 weeks or less. Trend being 2 to 3 quarters. You've heard Keith talk about this. And then tail being 3 years or less. And we've got ideas that fit both long and short side across all those benchmarks. So you can look at our idea list here, which is on slide 4. You probably don't have to know what slide it is because we're flipping them for you. So I've got that again at the end of the presentation as well. So you don't have to rush to take notes as to where certain names are on there. Top name by a long shot is Capri, which is a name I think is a 3-bagger over a 3-year time period. I think it doubles over 2 years. Since we put it on 20, it's up 45%, and that's only about 3 to 4 weeks ago. So it's a name that's got a lot of momentum behind it, very, very misunderstood, and I think it's a great call. On the flip side of that, we have Kohl's, which is our top short idea. And Kohl's is a name where if you heard this company on their conference call yesterday, I don't know what management was smoking, but I wish I can get some because they were just out to lunch. They're talking about getting to profitability levels that they were at 2 to 3 years ago. Even there have been such major structural changes to the business model at a time where they're going completely the wrong way with merchandising and assortment. And they're not going to comp to the extent that people think that they will next year. Their inventories are way down. They're not going to have product for holiday. This thing is a disaster, and it was up 10% yesterday. So I think that's a good name you could short. Hopefully you can ask questions about all these other tickers. Also, if there's a ticker that's not on here that you've got a question about, I've been doing retail for 26 years. I've got Jeremy McLean, who you heard from earlier. Jeremy is my top lieutenant. He's very senior. We divide and conquer the retail space. Certain names he specializes in, certain names I specialize in, and ultimately, and we challenge the crap out of each other and ultimately, attempt to come up to the best calls on our respective names. We've vetted hundreds of names out there, so if there's a name that's not on this idea list, please ping me with it. If I don't know anything about it, I'll tell you I don't know anything about it, but at minimum, I'll probably have a decent amount of information on it and a view to at least be dangerous, if not reckless. Hopefully not reckless. Let me walk you through on this next slide here. You've heard Keith talk about his quad model. I've got something that's a little similar. It is a quad model. I call it Sigma, S-I-G-M-A, Sales, Inventory, Gross Margin Analysis. Basically, and I'll slow down here just a minute. I don't want to bore you academically because this is kind of an academic type thing, but on your vertical axis there, you have your sales to inventory spread. So if you have sales that are growing at 10%, inventories that are growing at 5%, that's very bullish. That means you're going to show up at a positive 5 on that axis. On the horizontal axis, you have your year-over-year change in your operating margin. So if you're to the far right, that means margins are up. If you're at the far left, it means margins are down. Generally speaking, you want to be in that upper right-hand quadrant. If you can pinpoint a move, and that line there, I should be more explicit. That's about 5 or 6 quarters there. The past 5 or 6 quarters lined up over time showing where we are, and the blue dot is where we are right now in the middle of earnings season that's going on right now. You have retail earnings season that takes place about a month after calendar earnings season for all the other companies in the S&P. So we're dealing with this now. We had Target this morning, Walmart yesterday, Home Depot, Lowe's. It just keeps going on and on. But the point is, right now, we're at a point where margins are down, inventories are high, and sales are low. That's horrible. It's just absolutely horrible. Now, the big call here is that if you could move out of that quadrant into either quadrant 1 in the upper left-hand corner or quadrant 2 in the upper right-hand corner, you can make a lot of money. When stocks move from quadrant 4 up to quad 1 or quad 2, stocks don't go up by 10 or 20%. They go up by 80, 90, 100%. I mean, that's when stocks double. And that's what Jeremy and I really look for. A lot of analysts out there in the old wall, they basically are looking at, hey, I'm going to upgrade this stock. It's got 12% upside. I think it's a strong, strong double secret buy. I don't care about 12% upside in a stock. I mean, I do. I'll take it on a trade. I work with Keith a lot on these levels. And he's very good at identifying inflection points on a trade duration, also a trend duration. But what I really want is something that's so misunderstood, whereby you're going to see earnings that are going to double versus where the street is, that you're going to see earnings get cut in half versus where the streets are, and these stocks just move in a huge way. It's several standard deviations above or below where the consensus might be at any given point in time. So this is a real key tool of ours. I don't always show it. I don't always put it in all my reports, but it's one of the first things I look at anytime a company reports earnings. Where is it on this sigma analysis? And this is something I've been using ever since day one. I started at Hedgeye, which is 13 years ago, I think. I think I'm employee number 3. Okay, next slide here. And I'm just going to flip around here a little bit. There's no continuity here with slide 1 to slide 2 to slide 3. This is something that we're dealing with right now. This is the bankruptcy cycle. So basically what you're looking at here is, Jeremy, we've had how many bankruptcies? 35?
We're up to 40 now.
40 bankruptcies year to date. So last year, we set a record, an all-time record, as you saw the acceleration of e-com, putting mom and pop retailers out of business, and now COVID accelerated that. We've had, 40 bankruptcies for the year to date, as Jeremy pointed out. Over half of those have been in the apparel space. So apparel is having a very, very major problem right now. There are other retailers like we just saw, Guitar Center file. We saw Pet Value file. I mean, there are these little like niche retailers that just can't hack it anymore. But overall, apparel is where the really big problem is. We'll still probably have a couple more bankruptcies over the course of the year. An interesting trend here is that we started to see the mall REITs go bankrupt. So you had CBL and Preet, which are 2 mall REITs that own roughly 130, 140 malls, which is roughly, what would that be, about 11, 12% of the total malls in the country actually went bankrupt. I think that means we're starting to get to the back end of the bankruptcy cycle, which would be very bullish. And if companies can make it through holiday and actually get their cash in and their receivables are paid, that we could see a slowdown in the early half of next year, in the early first quarter of next year. But I mean, that's going to be a very, very critical point as far as retail and bankruptcies. But I'm on record as saying that, we're getting to the end of the bankruptcy cycle, especially as comps get a hell of a lot easier next year. And we see operating leverage off of higher sales numbers with lower SG&A, and companies push through higher margins. than they did last year. Certain companies will. Certain ones are going to fall short in a miserable way, which is why I love just their names where they're huge longs, other ones huge shorts based on that theme, which side they're going to end up on. Next one here, next slide I think is interesting. This is like a super duper long-term back to 1900 slide showing you what retail square footage has looked like. So we have about 13 billion square feet of retail square footage space right now. But as e-com actually becomes a much greater part of the overall spending equation out there in the world of retail, going up to, we've got it going from a high teens number to about 25% over the course of 5 years, which I don't think is optimistic at all. I think it's very realistic. E-com ultimately is infinite square footage. It's just online, it's all virtual, and you can get as much product out there as you might want. What that does is it marginalizes the existing brick and mortar retail square footage. So that red line there that slopes up, that basically tells me that as e-com gets to better productivity rates and profitability rates, and ultimately a greater percent of the total sales out there in all of retail, you're going to see this implied square footage double after us being at a point where it's been relatively flat over the course of, call it a 3 to 4 or 5 year time period. So you've had mass bankruptcies, back to that slide a few slides ago. You had these mass bankruptcies over the past few years. It stepped up big time. And now you're going to see a big explosion in e-com, which is going to really marginalize some of the weaker players out there. And those are players that have to go away in order to keep the supply-demand balance at a point of equilibrium in order for companies to not see a big productivity hit and a big profit hit.
One call out there, Brian, is that, this was not a COVID theme. It's one we've been talking about for a few years, and we really saw the sort of implied square footage increasing in the data around 2015, 2016. We think it's not a coincidence that that's when you start to see retail bankruptcies increasing, as we're actually having a consumer, improving on the margin, consumer ramp, and you saw retail bankruptcies increasing. That's this implied square footage dynamic at play, which is only accelerating now.
Yeah, exactly. Yeah, that's a great point, Jeremy. Let's talk about some more near-term factors here. Next slide here. You're going to look at the trend in retail wages. They are through the roof. Actually, if you flip to the next slide, you see retail wages versus total private industry wages over time, and you could see that there's been a steady, a steady discount across the board ever since 3Q05, with retail wages being well below where private industry wages are. Over the past 2 quarters, that is completely reversed. Now retail wages are at a premium. And what's interesting, you heard this from Home Depot, you heard it from Lowe's, TJX earlier today said the same thing. Target is up to a $15 wage. Walmart, 165,000 associates are getting pay raises. You can't avoid, and then you have like the Kohl's of the world who is saying, no, we aren't paying employees any more money because our employees just love working here. They just love working, so they'll do it for a lot less money, which I don't get because it's ridiculous. So the point is, Costco is one I would highlight. They've been paying hero pay, pandemic pay. You're out there on the front lines, you're grinding away, you're coming in contact with people every day, and you have to be compensated more just to be near these people and risk actually being infected. And they paid $14 million incremental per week. And on the last conference call, and I'm long Costco, I think it's a great idea, but even they're talking about, yeah, we can start to peel that back now as we start to get into a post-COVID world. Sorry, folks, you can't do that. You can't pay employees more and all of a sudden come back and say, okay, COVID is starting to wane, or now we have a vaccine, so I'm paying you less. It just doesn't work. So all I'm saying is one of the largest expenses for a retailer is wages, and that is going up at an accelerating rate, which is very bearish. Jeremy, please hit on this one because you're our in-house credit expert. But one of the other big issues here is that you've got a number of these retailers that have what we call a powder keg of credit income. So these are companies where they have private label portfolios. You go into a Kohl's, you go into a Target, you go into a Best Buy, a Dick's Sporting Goods, whatever it might be, and you go in there and you actually use your store card. Macy's is a big one, in order to get a discount. And the management teams of these companies don't really disclose very readily how big of a percentage of operating profit that it actually is. I know, Jeremy, I asked you to hit on it, and now I'm going through it, but I'll pass it over in a minute. But you got like Kohl's, who's got this partnership with Capital One, has 70% of its EBIT, 70% that comes from credit. So they're talking about, oh yeah, we're going to sell a little more athletic product. We're going to do a little bit more in beauty, and we're going to sell more in home. What about credit? It is a massive risk to the portfolio here, especially as we see the increase in unemployment, even though it's been getting better on the margin. The fact is, you can see a big divergence next year. Jeremy, want to add just another 1 or 2 cents on that one?
Yeah, sure. I'll just for clarification, this is percentage of EBIT on 2019 numbers, right? Pre-COVID. It's obviously much more significant now since retail's been collapsing in terms of profitability. But there's the big thing I think people should understand, and I saw there was a question in the QA here about Kohl's guidance on credit. They're talking about credit recovering with sales, but the way the portfolio works, it really has nothing to do with, it doesn't correlate at least with sales. It has something to do with it because people need to build their balances. But there's a receivables balance, right, that gets financing charges. There's late fees if they're not paying that. That revenue is shared with between the card issuers, Capital One, Synchrony, et cetera, and the retailer. And then they also share in the costs, which are funding costs, which are pretty minimal, but then share in the bad debt risk. So we've been seeing retailers have their credit income down in the recent quarters, but it's because of lower balances and less late fees, as consumers have actually been paying at higher pay rates. But we think there's an impending risk on the consumer credit cycle, because every cycle we've seen, you have a rise in charge-offs, and that becomes de facto losses on the portfolio that will get shared with the retailers. So when Kohl's is guiding, it's just going to recover with sales, I would flag, you saw Target today put out 21% comps, and their credit income was down 7.3% or something like that. So, they're not correlated. If your receivables balance is going down or your bad debt's going higher, it doesn't really matter what your sales are doing. So want to make sure people sort of understand the dynamics of the portfolio and why we think it's a huge risk is, if we see that sort of credit cycle rollover, there's big losses potential in the portfolios, which just accrues directly to the retailers. And now this cycle, the exposure is anywhere from 3 to 5 to 10x what it was back in 2008, 2009, because credit has gotten more profitable for these retailers, and the retail operation has gotten less profitable. So that's our view overall on credit.
Yeah, and the credit names like your Synchronies and your Capital Ones, they trade at like 7 times earnings, and you get your retail operations that trade at anywhere between 10 and 25 times, depending on who you are. So that's definitely something to keep in mind, and that's a big area of focus for next year, particularly if we don't get stimulus. If there's no more incremental stimulus that comes through, we're going to see a really big tick up in delinquencies, which is going to be a big problem. So with all of those factors mentioned, if you flip to the following slide here, it just shows the next 12-month earnings expectations. It's kind of a revision factor. So basically, since March of 20, no shocker. You had a really big decline in overall earnings expectations on the part of the street. Now, if you look, I don't know if you could even see that tiny little blip way to the far right here. We're finally at a point where we're looking at positive earnings again. It'll get a lot more positive than that. Again, we're going to have 2 quarters here, which are going to be really, really easy to anniversary. You're going to have companies who are going to be putting up monster numbers. The consensus is already there. Let's be clear about that. So it's all going to come down to where the companies are coming in relative to where the street is. But the point I'm trying to make here is earnings matter again. And there's a major point I have with that. If you look at the following slide, this is the tail or the multi-year, the 2 to 3 year top line expectations for all of retail. So we had about a 3% decline in 2020 for overall sales growth in our entire universe of retail companies. And in 2021, people are looking for a snapback of 13%. That pegs your 2-year average at about 6% or so. Which, look, that's probably about fair. I'm not going to argue with that. Sales numbers, they come and go, up and down, based in large part about what Keith and Darius are saying about the quads and the U.S. economy and where we're headed or headed away from. But I would point you towards the slide I do have a problem with, which is slide 13 here, which shows your tail margin expectations. Now, if you look at this, the column to the far left of this chart, that's 2015. EBIT margins for all of retail were 9.7%. They were down every year. We had some really strong years there as far as top line, really strong consumer environments, and yet every year they were down. Why? One of the biggest reasons is that you have a shift to e-com. E-com is margin dilutive. There's probably 5 companies I could count on my hand, which is good because I only have 5 fingers, that actually have margins accretive when they move to an e-com model. That's like Nike, Adidas, Under Armour, a couple of the Capri Brands, more luxury-esque type companies whereby they make more money if they go direct to you instead of having to go and sell through a Macy's or a Foot Locker or somebody like that. But if you're Ulta, if you're Kohl's, if you're even Nordstrom, which I went bullish on this morning, if you're any of these companies that basically is just in the business of selling other people's product, generally speaking, you're going to see margin erosion as e-com becomes a bigger part of your business. So if you look at that trend, every single year, just down, 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 anywhere between, call it 20, 40 basis points. It was down a hell of a lot more than that in 2020. That had to do with reasons above and beyond e-commerce. But then you look at 2021. So next year, people are looking at an 8.3% operating margin. That's on par with 2018, above 2019. And then people are looking for another increase in margins in 2022. So I don't get it. I just don't see how that's possible. There are certain retailers that can do it. I mentioned Nordstrom earlier. I think that's a good example. Capri is a great example. They're going to have such big margin improvement over time, over short-term, intermediate-term, and long-term duration. So I can pick out several companies. Nike will be higher. Again, ask questions about any of these, and I'll elaborate on them. But as an industry, e-com is getting bigger. It's going to gain 500 basis points of overall retail sales growth, and that's going to take margins lower, not higher. So my gut tells me, and my analysis tells me, that you got the 8.3% number in 2021 is going to end up coming closer to about 7.5%. And 2022 will be even less than that. So we've got and this is where I go back to our idea list. Don't go there on the slide deck. I've got it in like another slide or two here. But there's going to be a big blowout in companies, some who are improving margins to a large extent, others who are just going to take a complete bath. And it seems like Wall Street is really painting these all with one broad brush. So I think it's a great opportunity for some really good alpha generation. So let's skip this next slide here. If there's a question on Capri, which I hope there is, I'll go back to this slide here. That's my top idea alongside, but I'll just leave you with my idea list here. We're about 25 minutes in. Jeremy, I don't know if you have any questions there lined up, if people want to talk about individual tickers. If so, let's go there and let's get it done.
Sure. So yeah, if you have any questions, plug them into the queue there below the video player, and upvote the ones you really like. First one I'm going to start with here, Brian. Can Chewy hang on onto a post-vaccine world? Can Chewy hang on to a post-vaccine world? I guess what's the outlook lapping COVID for Chewy?
Yeah, look, I mean, Chewy acquired 3.2 million net new consumers in the first 2 quarters of this year, which is more than it acquired all of last year. There was clearly a COVID benefit. People don't want to go to pet stores. 70% of the people who subscribe to Chewy are on an auto ship model where the food just gets sent like on the 15th of every month. You got to feed your dog or your cat, or I have 5 dogs. I got to feed them all. I'm probably Chewy's biggest customer. Which is a sad statement about me. But the fact is that the net customers that they brought on this year, you spend about $150 a year as a year 1 Chewy customer. Then in year 2, you spend closer to $250, $275. Year 3, you go to $375, $400. There's a material ramp up in the average spending per consumer. So what you got to look at is there'll be a little bit of a trade-off. We will not see a decline in the total customer count at Chewy, but we'll probably see a slight decline, a slight tempering in the growth rate of new customers being brought on, but that's going to be offset by higher average spending per customer. So it's still going to drive a top-line growth rate in between 30 and 40%, which I think is key. That's going to happen at the same time where the company starts to adopt an international model. It's going to go to Canada first, and then it's going to go to Western Europe, and then it'll probably go to Australia. It's people across the world think about there are certain parts of Asia where they don't quite care about their pets as much as we do, which is why that's not at the top of Chewy's list. But overall, in the UK, very pet-friendly environment. Australia, very pet-friendly environment. Canada, which will be their first big shot. The great thing is that they can leverage the USDC infrastructure, and they can actually just ship into Canada from the US without the added capital costs. So I think there's a lot of things to like about the Chewy model. Cash flow break even this year, GAAP earnings break even next year, and then they are on a profitability ramp in the years thereafter. The stock has been working great. I worry a little bit about getting greedy on it. Yeah, but I mean, I still think as I look at how this thing is valued on a price to sales multiple, which I hate looking at, mind you, as a retail analyst. I'm not a tech analyst. Our tech analysts here are great, and they got that price to sales thing all figured out. But in retail, I like looking at cash flow. I like looking at earnings and like real tangible earnings metrics. And I think we'll actually have that with Chewy, and the valuation narrative will change over the course of a tail duration. So that's my way of saying I still like it. I still think it's an $80 to $90 stock over a 12 to 18 month time period.
Gotcha. All right, next question here. There seems to definitely be some interest in Michael's. People probably liking the leverage and multiple on that one. But the question is, Michael's is no Capri, but where do you see Michael's going over the next 12 months?
I'm I'm not going to respect the premise of the question. I'm going to change it around a little bit, and I'm going to say, where do I see Michaels going over the course of 3 to 6 months? Because ultimately, I think that's where the trade is. This is not like a high conviction, 3 to 5 year name like an RH or Capri, where they're completely dominating their space and having an accelerated growth rate and moving towards luxury multiples. This is Michael's Stores. It's where you go if you want to get a picture framed or you want to buy arts and crafts. But the fact of the matter is, we're still dealing with COVID for, in many quarters. I still think come next Thanksgiving, we're probably still wearing masks. That's just my opinion. I don't know what our official view is from our healthcare team. But it's something that we still have to deal with. And while you had sporting goods as a category, you had electronics, you had home, that really drove earnings for a lot of these companies over the course of quarters 2, 3, and to a certain extent will drive it in the fourth quarter. Michaels is going to really take over, and it's going to be much more indoor based, arts and crafts based. Last conference call, the company said they were comping up in the high single digits. Our data shows that they were comping above that. Ultimately, I think it's going to have a very good quarter. The guide will probably be soft because that's what Michaels does. They guide soft. But this thing is, Jeremy, what's the short interest on Michaels now? Like 40%?
I'd have to check. Maybe not quite that high, but yeah, it's pretty elevated and it's trading at a very low multiple. So, upside in the near-term earnings would be in a pretty big stock change, I think.
Yeah. Yes. So this is a name. It's more of a renter than an owner, and it's like a 3 to 6 month call in my mind.
Gotcha. Number 3 question here. Any thoughts on Lulu? One we haven't been talking about quite as much recently, but we've got a lot of history with being both bearish and bullish.
Yeah, I'll tell you, Lulu benefited from COVID to a large extent. People are buying comfortable clothes, workout clothes. To an extent, Nike did too. It did relatively well. They went ahead and they bought Mirror for $500 million. There's a part of me where I look at that, and it's like when Under Armour bought Endomondo and MyFitnessPal, and it's connected fitness initiatives, which did not end up adding a whole lot of value for Under Armour shareholders. In fact, now they're getting rid of them. So I wonder to an extent if they're kind of jumping the shark on this one, and this is them calling the top. But I still think, look, it's a great brand. They have buy-in from their consumers on a global basis. They got a really great men's business, which is still probably in the 3rd or 4th inning, and they've got a lot of upside there. They started a footwear initiative. It didn't really work out very well, so they probably won't move forward with that. Am I averse to owning a name like Lulu? No, I'm not. Would I put fresh money here? No, with the stock at like $335. That's just out of memory. I think that's about where it is. No, I wouldn't. But I also can come up with a compelling short against it. So this is one of those ones where I'm just kind of watching it. I'm waiting for some controversy, which I could weigh in on and ultimately be off a consensus either one way or another. So I'm kind of agnostic on Lulu.
Yeah, you don't want to forget that very bearish data point that I bought my first Lulu product and they did their spring sale here this year.
Yeah,
if I'm buying it,
Jeremy can kill a brand like nobody.
I'm the most utilitarian shopper. Brian's the brand guy here. So. All right, next question. So somebody says, first, a big thanks. Been long. Chewy, Capri, Costco, RH. Other than Capri, rightly or wrongly, all have COVID element with them. How will this sentiment play into next year with these winners? So what do you think the risk, if any, on particularly Chewy, Costco? We were hit on Chewy, but Costco, RH, as it relates to lapping COVID and sentiment next year?
Yeah, so I'll start with RH because it's a name which has I don't want to say made my career, but it's probably the best long call I've ever had in my career. We were long it at 30, and now it's at 435. And quite frankly, I think it's going to 800. And the company is just embarking on an international growth strategy. It can add stores in the U.S., not because it can, but because the consumer actually wants it to, over a 5 to 10 year time period, and not dilute its own demand, which I think is really huge, and you can't find that anywhere out there in retail. At the same time, where now they're going over to Europe and they're building stores in Europe. Europe's even a more highly fragmented furniture market than you have here in the U.S. So I think RH is going to absolutely crush it over in the UK. Now, that said, as I look at it, RH is the top name on my long bench. Why isn't it a best idea if I'm telling you it's going to be an $800 stock and it's now in the 400s? There's got to be a misstep. There just has to be. RH is good for a misstep every couple of years. You know, the brand tries new things every day. They're not afraid to accept the fact that every day the plan changes. And that's what's made them so successful, but they go with the flow, and occasionally they'll misexecute. And I don't blame them for it. Well, no, I do blame them for it. I mean, if they made a mistake, they made a mistake, and they got to deal with it. But what dealing with it is usually having a big drawdown on the stock price. So, as I look at the outsized demand that we've had in the home space, anything that's remotely close to the home, if you look at Wayfair, At Home, WSM, RH, the home business at TJX, Kohl's home business has been on fire, and it's Kohl's. Kohl's is a piece of garbage. It's just the home has been an extremely hot category overall. I think it lasts a little bit longer than just anniversary and COVID, and all of a sudden no one's interested in homes anymore. You buy a new home, there's been a huge amount of housing activity, and ultimately you're buying furniture over a multi-year time period. But I think sales and overall demand are inflecting to the downside. And when you're carrying a 20, 25 multiple and you see sales that you see a demand trend going from plus 46 to only plus 20, well, that's probably not a multiple expander. And if at the same time they're putting capital into a European model, that'll probably be dilutive. They might have missteps over there as they have to learn a new market, new logistics infrastructure. It could get hairy. So I'm waiting on that one in order to, have that pound the table, like, hey, let's do a black book and map out how this name actually gets to an $800 stock price. So I think that'll happen over the course of a year and a half, hopefully sooner, because I want to make that call. But that's how I look at RH. Jeremy, other tickers were what? Costco?
Yeah, the other one was Costco. Before you hit on Costco, I'll give a quick thought on RH too. But there's kind of different elements to home, right? There's a lot of buying a desk and buying some decor because you want to redecorate while you're stuck at home. The dynamic that we think can definitely last longer, and this is something our housing team is talking about, is this migration out of cities. We don't think that's like a couple quarter event. People are going to realize there's risks of another situation where you have closing down, et cetera, in a city, and on the margin, people are going to be looking for properties or alternatives outside of your city center. So this sort of migration out and upscaling, therefore you need more furniture to sort of fill those properties. This is obviously much more of a dynamic on the high end, which is where RH plays. So I think that's a little bit more of a longer term trend than just a few quarters, and then we have an issue lapping it. But I just wanted to add that context.
Yeah.
So
and
Costco. So, sorry, go ahead, Brian.
Yeah, and I would just add that on the short side, we have Wayfair, which has been a huge play on the home. Wayfair has been putting up tremendous top-line numbers, as you saw, the Amazons of the world. Bed Bath & Beyond has been a complete mess. The home businesses with the Kohl's of the world that were closed down for a number of months, and Home Goods was closed down for a little while. and it all just accrued right over to Wayfair. And this is a company that has never made money, and all of a sudden you have 2 quarters where it just printed money. And the rate of change there is going to slow very dramatically next year. It's a name that trades on rate of change. And as we re-rate it based on where the top line trends are coming in, you get to 40 to 60% downside on Wayfair. So it's a name that we don't like over a tail duration. There are some people who are passionate about it. They love this thing and they'll support it at every chance they can get. But overall, we're coming in on the bear side of that one. And I would definitely pair that against RH, especially once I'm ready to make that really big RH call again.
Gotcha. Then do you have any other Costco thoughts there?
Costco, look, I mean, people, Costco has about 54% of its business is grocery. And then it sells other things like electronics and home goods. You could even buy a coffin at Costco, which is about as morbid a data point I could throw out at you. But the fact of the matter with Costco and with the consumer in general, people are consolidating their shopping trips. This is why you've seen, like at Walmart, their transactions have been down by, a double-digit rate. But what they spend when they go to the store is actually outsized on the upside. Costco, which just declared a $10 special dividend yesterday, which I think is a really big deal, or the night before yesterday. They're really executing their capital model really well. I think they're going to still have a benefit over the course of all of 2021 with these, the outsized spending as people consolidate their shopping trips. I think e-commerce is like a sleeper stock driver for Costco. It's been growing 93% over the past 2 quarters, and it's something that I think is going to accelerate over time. Costco's been hell-bent on getting you inside that store, and now they're finally starting to get it, that they can actually have a very profitable e-commerce business. And Costco International is also a really big driver. They've got a business in China. They got stores all over the world. I would like to see them grow those stores a little faster and do more aggressive store rollouts in that regard. But overall, I think at this point, over the course of a 6-month time period, I think Costco is a $400 stock without much resistance.
Gotcha. Just for reference, I checked the Michael's short interest. You're right; it's right around 40%.
I love when you tell me I'm right.
Well, 39.6. So we'll round it for you. So, question here: you've hit on a bunch of the other ones here about Wayfair and RH long, so I will skip some of those. But can you speak to the out of favor names like Guess, Gap, and Gildan? And I'll start by saying I'm not sure Gap is out of favor right now. I think it's trading higher than it was sort of pre-COVID before it announced this next round of restructuring, and I'd say we see pretty significant risk to where the market seems to be implying long-term earnings are and where we think it's going. I think you got to believe in a turnaround in the Gap brand around, maybe Yeezy's a catalyst for that, but I don't see how that's really big enough. You have to talk about several $100 million to billions of dollars for that brand to get the sales number you need. But anyway, Brian, I'll let you hit on some of their Guess, Gap, Gildan. Gildan's certainly been doing better lately, and the question acknowledged that. But maybe thoughts on upside more so than from here.
Yeah, and I don't have a major call on Guess right now. This is I was on the macro show with Keith a couple of months ago. I mentioned it, and it had a really nice run. The company still has a lot of issues it's got to deal with, but it's got very good management now, and it still has a big margin recovery story. And as it culled some of its bad stores this past year, right-sized its SG&A structure, Guess, they actually do have more of the kind of going out type clothes that they saw in the stores, which you could see a snapback next year on top of a more lean SG&A structure. You could get back up to a high single-digit EBIT margin, which would basically double EPS. Is that my call on it? No, but is that what my gut tells me happens? Yes. I just have more work to do on that one. It's not a name I'm asked about often. Maybe it's because of the cap. Maybe it's because it's just been so out of favor for so long. Maybe because it's been out of favor for as long as it has been is exactly why I should be going there. So that's exactly why I appreciate questions like this, because it makes me think about kind of where I should be spending my time. The other out of favor name, Jeremy?
So Gap and
Gildan.
And Gildan, if you have thoughts on either of those.
Yeah, why don't you hit on Gildan?
Yeah, so it's one. Obviously, we think the long-term story is very powerful to be, have a real moat. They're really a manufacturing company, right? They have a brand, but the brand is minimal in terms of what the business is. They operate in screen print, making very inexpensive fleece and shirts, and they have a new private label partnership with Walmart that's been going very well, growing shelf space, growing share with the George brand. And the sort of issue with the stock right now is there is a very large portion of the business that's tied to events, so concerts and sporting events that aren't happening, and we really don't know exactly when they'll be happening. It seems like it would be sometime in 2021, but we don't know for sure. And then it's a big amount of business tied to corporate promotions. So you get your shirt when you get a credit card or something that they're just those corporations have been pulling back on in terms of that promotional level. So I would say the stocks may be pricing in a little bit too much on like near-term earnings, but what the upside is when those things come back, your rate of change should remain positive, and we think there's the upside to $3 in earnings power in the stocks. I think in like the mid-20s. So I think there's very significant upside. The next couple of quarters could be a little bit squirrely. They've kind of gotten to what they think is their sort of near-term utilization rate or production rates in their mills around 75%. They'll be able to generate nice profits and cash flow there. But in terms of getting the big earnings numbers, it might be another 12 to 18 months before we start seeing that really flow through on the P&L.
But it's still a name that we do like. It's on our best idea list. Yep. It's just a function of when will a cotton T-shirt have the kind of utility where it's part of our mainstream economy again. And that all comes with opening back up again, and that just takes time. But it's still there. I think very difficult to paint a bear case around Gildan here.
Agree. Yeah, the rate of change will probably only get better from here. I think the stock's pricing that in some, but it's far from where it should be in terms of the tail earnings power for sure.
Yep. All right. How are we doing on time, Jam?
I think we got to do another 5 minutes here at least. There's a couple specific questions I want to hit on. So you mentioned this earlier, so why not hit on it? But what is the upside for Capri? You want to go to that slide, perhaps, Gendron?
Yeah, so check out the slide, the second to last slide in the deck. You can basically look at that one and see where it is. The crux of this is that Capri is the former Michael Kors brand. Kors was a hot brand. It was doing 32% operating margins up until 2015. Then the quote-unquote accessible luxury handbag space just started to really ebb, and growth rates slowed, margins slowed, and this thing and it's always been a hedge fund trading stock, and it basically got like a 5 times EBITDA multiple. I mean, it was just crazy. And they went ahead and they bought Jimmy Choo and Versace. These are 2 really high growth, very, very powerful assets. And they bought them about 2 to 3 years ago, and they said flat out at the time they bought them, which a lot of people thought that they overpaid, that it was going to be 2 to 3 years until we actually started to see both the top line growth and the margin profile accelerate. And what they're doing is they're fixing the mix between footwear, accessories growth, men's ready-to-wear, women's ready-to-wear, licensing. You've got to optimize all of these by channel, by geography, online versus in-store versus in a department store. I mean, it's very, very complicated. And they bought companies that basically hadn't had management before. Or they've had management, but they were founder-led companies where you had a designer that was also a CEO, and that never ever works over the long term. So now that's what they got. In this year, you have 100% of EBITDA, which is the low multiple Michael Kors brand. They're down about $1 billion in sales this year as they rip the Band-Aid off a bad distribution, which takes margins up. They just put up a 24 operating margin in the Michael Kors brand in this latest quarter, which blew me away. That's part of what got his stock up to a certain extent over the past 3 to 4 weeks. But starting next year and the year after that and the year after that, you're going to see Jimmy Choo and also Versace, which are going to become a greater part of the portfolio. Those are luxury assets, any way you cut it. They're luxury brands. They fit right in line with the LVMHs and the Keirings of the world and the Burberrys of the world. And, those are much, much higher margin, much higher multiple companies. And I think the company is sandbagging the long-term margin profile associated with those companies as they grow again. And then you're going to get multiples on top of those instead of having like the 5 times EBITDA multiple that you get with Michael Kors. You're going to get, 10, 11, 12 times on the EBITDA associated with these growing divisions. Ultimately, I have like right now today stock worth roughly $30, which is probably about where it is. If I'm looking forward a year, I get to $45. If I'm looking, 18 months out, I'm looking closer to $60. So this is like a 12 to 18 month double. And ultimately, over the course of my modeling time period here, which is 5 years, I know that's like an eternity, but I get to $100 stock. So it's funny is that this thing is owned by hedge funds. It's rented by hedge funds, I should say. There's no long-only sponsorship. And I think long-only investors are going to be stepping up and buying this thing at $45, $50. So the stock is going to keep working. It's going to keep working a lot. I think the back half numbers that the company set are very doable and they're beatable. I'm ahead of the consensus. That's not the reason for my call, but it's definitely something that supports the call. And people are going to wake up and realize that there are these underappreciated, overgrowing, not growing too fast, but very rapidly growing high margin assets, which are evolving inside this company, which are going to be worth paying for. So is there as much upside here as there was at RH? No, RH is a 10-bagger. This is a 3-bagger, maybe a 4-bagger. But it's one where I would caution you against selling it too early. Do not sell this early. Don't say, oh, great, I just made my 60% upside on this name. I'm going to book a gain and get out of here. If you want to use Keith's levels, he'll tactically trade that, and he'll, over a $30 stock move, he'll hopefully make, a $50 to $60 alpha range based on that. As he rides it up and rides it down, and he plays his ranges. His risk ranges are very good. As all of you know, but this is one, if you're a tail investor and want a name you could stick away and just watch it grow, look no further than this one, and then look at RH once it takes a step back on the European expansion.
Yep, and I'll just I know I can hear Keith saying when you hit those ends of the range, you sell some and buy some, right? It's not opening and closing the position every time. It's signaling on, add or subtract a little bit, so risk manage the position.
Right.
All right. One last one, Brian, and then we'll kind of close out here. But VFC, how does this compare to Nike, Under Armour, et cetera, in terms of ability to benefit from more business going online? Are they taking aggressive action to close less profitable doors? So
I heard Nike, I heard Under Armour. I didn't hear the ticker you're talking about.
It was VFC.
VFC. I don't get this company. It's a serial acquirer. It doesn't really grow well organically. It has one brand that's doing well, another brand will take it down. It's got to go ahead. It's got to buy new brands. It just bought Supreme, which It paid a very hefty price tag for, and it was probably a very good deal. But it's probably bought that because its Vans brand, which has been the driver for the stock over the past 2 to 3 years, is getting long in the tooth. I think the spirit of the question, which I just ignored, is will a shift over to e-com be margin accretive as the company just goes more DTC? And the answer is yes. I think it definitely will. But where I have a hard time with is as they have all these other non-core brands. They got Timberland, which hasn't grown in God knows how long, and they overpaid there. They got Vans, which is a very good brand. They have North Face, which is kind of hit or miss. Are you going to make a bet on it being a cold winter this year? Good luck with that. But yes, they do benefit from higher margins as they go more DTC, but that's not the key to the call. That's your Nike call. That's your Under Armour call. That's your Adidas call, where you can actually model a good 300 to 400 basis points margin improvement just as we come out of a permanent shift and we move on with permanent shift from going to a wholesale model to a DTC model. But be careful with that on VF.
Gotcha. All right, I think we'll wrap up the Q&A there. I just want to remind people they can check out the Retail Pro. It's a new product that we think is exciting and is only going to get better. We're going to take your feedback and tweak the product profile to make it more compelling and more valuable for all your users. So please check that out. I think, Brian, we're going to do a call with Neil Howe right in December, talking about what's retail going to look like here in a post-COVID world.
Yeah, we're going to mess. Yeah, we have a lot of history, a lot of great historical data on retail going back to, when it first started with the Sears catalog, like in 1886. And that's about how far back Neil thinks as well. So I anticipate it's going to be a really good, really thoughtful, data-rich and insight-rich on Neil's part as far as kind of how the world of retail is changing and where you want to be invested and where you don't want to be invested. So that's something you won't want to miss. That's going to be on December 8th at 12:30.
Gotcha. All right, so check it all out. Thank you all for tuning in. We look forward to having you on future Retail Sector Pro events, and have a great rest of your day.